Okay, I think that's a good place for us to start. Thank you everybody once again for joining us for the webinar today via AMGC Connect on Getting Investor Ready. We're joined by Chairman of AMGC, Paul Cooper, who is also a manufacturer himself, has been well experienced in the industry and both as Chair of AMGC to talk on the topic of raising capital and getting investor ready. Before Paul gets underway, just a couple of things I'd like to touch on. Paul, if I could have the next slide, please. Just a little bit about AMGC. We're the peak body representing Australian manufacturing and manufacturers. We provide all levels of services and solutions on all things manufacturing, including advice to manufacturers and to government. We've proven industry experience, and our network covers 220,000 employees across 12,000 industry contacts and 4,400 members. We have run co-investment programs and currently run co-investment programs for different state bodies, and also our involvement with the Industry Growth Program. We have a national support network, and we also operate in a couple of different areas, including media and research services, consulting services, and advice to government. Next slide, please. As part of our services under the Industry Growth Program, AMGC Connect is offering a range of support for any participants in the program, spanning one-to-one, which is really in-depth and personal services across any challenges you may have with your operations or preparing your business for growth. One-to-few, which some people will have already joined us on either best practice tours, meet the experts, or other opportunities to collaborate, and then our one-to-many programs, which you'll be partaking in today as a webinar. Next slide, please. So as part of this, we're joined today by Paul Cooper, AMGC Chair, to talk about getting investor ready. Paul has run manufacturing businesses, has advised manufacturers, and also has invested in manufacturing operations. So I will now hand over to Paul. Paul, we have a great turnout today, so I'll hand over to you.
Yeah, it's wonderful. Thanks, Tyson, and thanks, Amelia, for the help on getting all of this together. And welcome everybody from across Australia on the AMGC Connect. So excited to sort of bring you some details of what a lot of people have been asking on our one-on-ones, and that is, how do we get investor ready? What's the right thing? So what we're going to do is step through these. We're going to look at initially what your business structure is and whether it is investor ready, and what needs to happen in the stages towards getting that. And then what type of investments you might be looking for in what your stage of growth. And I'm going to tie that back a little bit to your technology readiness level, your TRL, and see how that aligns with the various capital raising opportunities that are out there. And I'll also be looking at some tips for finding the right type of investors or debt and equity, and then digging into some of the, I suppose, tips and traps when you are raising capital or loans, and how they fit with the investment. So I'll spend a little bit of time on that. So it's great to see that we've got a huge number of, we've got nearly 100 manufacturers on the call right now, and there might also be some fundraisers. There could be debt providers as well. And there are certainly people from Department of Industry in Canberra as well on the call. So thanks everyone for attending. And as Tyson said, Q&A is there, and we'll allow some time at the end for the Q&A. So is your business ready for investment? Now, a lot of people, I've done one-on-ones with a lot of people who are looking for capital, and there is a range. There is a range of people who haven't really got their investment structure sorted out correctly. And I want to just go through those and talk about them. So if you've got, if you're running a sole trader or a partnership, you are not investor ready for capital coming into your business. If you've got a family trust, you also can't have outside investment, and that's a tax rule that you can't have outside equity investment in a family trust. So it would breach the family trust guidelines on how you then distribute profits. So there are some original structuring deals that you need to get set up to get yourself ready to take on outside investment capital. Now, whether that is equity or quasi-equity, and I'll go through some of those things as well, you need to get some advice. So go to your accountant or your planner and get some advice on whether your structure is able to be used for outside investment. Also, have a look at your balance sheet. I did spend 24 years in finance and accounting, and when you look at some balance sheets, there's a whole lot of stuff on balance sheets that have got nothing to do with the business. There can be private assets on there. There can be loans to other corporations or within your family group. They are not ideal to have on your balance sheet when you're looking at taking outside equity. An outside equity investor will want to see a clean balance sheet with nothing but the assets needed to run the business going forward on your balance sheet. So just need to make sure that you've got that cleaned up. Don't want to see boats on balance sheets. So move them out and get things cleaned up so that only necessary parts of the business that you're needing the financial support is on there. If you've got 2 or 3 types of business in the one, again, get the message really simple for investors. Clean out the stuff that's a distraction to your business and a distraction to you. Clean it out of the business because that's the balance sheet they're investing in, and make it nice and clean that way. Also have a look at where your current loan structure is. Quite often there is debt in the company and there's no assets to support it, because what's happened is that the owners have gone to their bank, mortgaged their house, put the money into the company, and either the loan is in the company or a loan from them into the company. So just have a look at seeing whether you can move that outside supported asset to within the company. Now, often you can't move your family home into the company. In fact, never do that. But if it's an outside investment, sometimes those things can come in. If it's the shed or the factory, they can come in onto the balance sheet. Get advice from your accountant on the capital gains issues there. Or see if you can actually do it the other way around. Move the debt that you've got, which is supported by outside assets. See if you can move that debt onto other assets in your business. And there is a lot of flexibility in the Australian banking system where you can use accounts receivable or invoice financing or even export financing, where you can use assets in the company to bring on that debt. Make sure the timelines and you have clear exit strategies. As you go into a business, always think about where's the exit door on the business, and look in your business every month, every year, whether there's an exit pathway that's starting to emerge. Because those exit pathways might need an additional amount of capital in your business to be invested, and you might need to bring a partner in to allow you to access that opportunity. In all of these things, get professional advice before you need it. Say, this is my business plan. This is my 3-year, 5-year, 10-year, and this is where I think my final exit's going to be. Get some advice on how to properly structure your business to capitalize on that. You may not even want to have the company in Australia. That's going to deny you access to a lot of these types of programs. But if your ultimate exit is going to be the US, for example, or Europe, you may want to set up a company in that jurisdiction as the holding entity and have your operations back in Australia, for example, or your R&D team in Australia. So I'm not hard and fast on which way that should go, but please get advice on where you set up and how the structure is, particularly in the US. There's various types of structures you can use. Some are useful, some are far less than useful from an Australian tax point of view. Your investment location, where are you going to set up your production? Is it going to be here? Is it going to be in Asia? Is it going to be somewhere else? Have a look at your setup to see where your actual production is going to be, because that could be where you end up with some of your debt parked. So in my own business, we do electronic production in Sri Lanka. We have production in various hubs around the world, in Europe and in the US and Australia, of course. So sometimes we try to park debt where that funding is needed. So if we're doing expansion in the US, try to get debt parked in the US. Or if you're doing a capital raise, have a look for where that might be ideal to have your capital raise. So this concept of smart capital and patient capital, it'd be lovely if they were both merged and you found someone who was able to help you build your business, but also patient enough to hang around for an exit. So smart capital can be upline and downline. It can be your customers, it can be your suppliers, it can be your business partners that are looking in market. So if you're going to Europe, for example, you might have a major company you're working with in Europe. They may be able to provide some smart capital to assist you in that move into European operations. So smart capital is more than just dumb money being given to you. It's money that's going to allow your business to grow. Private equity is a really good example of that. If you're going to private equity, find a private equity provider who's going to be able to give you the connections and give you those growth pathways and possibly even exit pathways down the end. Patient capital. If you're looking for someone who is, if you think your investment horizon is 10 years, you'll be hard pressed to find someone who's going to park, money with you for 10 years. Often those people who've got money, haven't got a runway of 10 years of business activity in them. So they will want to exit after 4 or 5. So find out what their investment timeline is before you start committing to particular people as well. So what type of investments are you looking for? Now I'm just going to jump back in here and have a look at the life cycle of your investment, how long you need to have money in your business, and the volume of funds that you're looking to raise. There's a simple XY chart here. So if I just quickly go through these, if you look at down the bottom left-hand corner, you've got the Industry Growth Program, which is a program that you're connected to today through AMGC Connect, and it allows some investment from government through the Industry Growth Program. And I'd like to also say that's part of the smart capital side of it, because you're getting access to the participants, the IPOs like AMGC, to be able to assist you in growing your business. So the Industry Growth Program is a short-term program. It does have funds up to $5 million, but there's also access to obviously smaller pools of money in there. AMGC has also had its own funds in the past. We're still running the Western Australian Wind Energy Program for the Western Australian Government, and that's a pool of funds which we're providing out into industry to enhance the wind manufacturing process in the United States, in Western Australia. And that's allowing them to find manufacturers who are very good or in adjacent industries in the wind programs to provide manufacturing. We're also assisting with the Northern Territories Ecosystem Fund, and there's other governments in Australia that we're working with to assist them to roll out programs within each of their states. Within each state, there's also some programs that do have funds. So, for example, up here in Queensland, we have the Advancing Queensland program through the state government, but there's also QIC, Queensland Investment Corporation, and it's independent of government, but it has government pool funding, and it provides everything from very early venture capital right through to patient long-term growth capital in a private equity style or in loan funds. Each state will have their own. There's Breakthrough Victoria, for example. So contact through your own state governments to see what is available, or connect back with us and we can assist you in that. CRCPs, they're cooperative research programs. There are a few of them around, and the government, they're a long-term thing. So the funding is shorter term, but they actually live for 10 years, those CRCPs, and they operate over a longer period of time. So angel and seed funding, often only up to a 2-year cycle in your business and are generally small amounts of money. Venture capital, which is the next one up, they can be up to about 5 million, but generally in that sweet spot of around $1 million. And venture capital can be thematic. So certain venture capital funds might be pharmaceutical based, they might be manufacturing based, might be property based. So get a feel for the venture capital market and speak to us. We've got access through them as well. Another one which we've put in there, which is the Business Growth Fund, the Australian Business Growth Fund. It was established after the Haynes Royal Commission, where the government decided that there needed to be more emphasis on providing some sort of equity pathway for Australian businesses to grow. Now, ABGF can provide money. $5 to $15 million is their sweet spot, so their check size, $5 to $15 million. And they will take stakes up to 49%. They will even do intergenerational wealth transfers. So when a part of the family is retiring, they can back the new generation into that business and take out some ownership off the table for a retiring partner. Very flexible in that way. Now, each of these are sponsored, so ABGF initially by the 4 banks, but it's if your own bank, if you want an introduction to them, come through us by all means, but you can also go to your own bank and get an introduction to the ABGF. So they're active, they're out there investing, they've made a number of investments and also some follow-on investments into those businesses to allow those businesses to take over other businesses and grow. And one of them, I think, has done 3 or 4 acquisitions in the last couple of years through one of their investments. So private equity is what a lot of people speak about in terms of I'm trying to get someone to come into my business. Private equity is that next big bucket. The life cycle is generally more than 3 years and generally up to about 10 years. The sweet spot there is 5 million. Look, I've seen 5 million investments in private equity, but they'll go up to 30 million without too much problem in Australia. And again, private equity can be that smart capital, and it can also be an introduction to other growth areas. So if you've got a private equity fund that has a parent organization in Europe or in Asia or in the US, then they may be able to assist you in growing into those markets as well, and also providing that equity in that market. So they're an interesting area. Don't discount them. They're actually very, very good for growing businesses from Australia to international. Now, up the top there, we've got some very large federal government funds, and these funds have up to $15 billion in them in some of these funds. NRF was funded with $15 billion. So each one of those have their own sweet spot. The NRF, if you're not aware of it, it's the National Reconstruction Fund. It was formed about 2 years ago. They're rolling out investments now. I think they've rolled out 8 investments so far. Now, their investment size, their check size is a minimum of 10. Really, their sweet spot is about 40 million and above, but they can go down to 10 million. They can't take a majority ownership, and they generally don't want to be the lead investor. So that is a fund that looks to crowd in funding from others. So if you have a need for, say, $40 million, you could get 20 million from the NRF. They will assist in finding others to crowd in, or you go to your own bank, or you go to other private investors or private equity, and crowding in that money to get you the total funding you need of 50 or 100 million. That is available through the NRF. Now, they're not working with smaller companies at this stage, but I think there's a model there that they are looking at to try and look at that pathway to see if there's a pathway. It would mean a major change from the government and a change in their investment mandate, but to try and access for small businesses, there might be opportunities coming down the track. Keep an eye on that one because I think it's useful. Arena. Arena do provide some funding, so it's the Australian Renewable Energy Agency. It's around renewable energy and investment in that area, and I think they're around the $10 million, $5 to $10 million amounts. NAIF, the Northern Australian Infrastructure Facility, focused on north of the Capricorn, and they're looking at $10 million investments. Export Finance Australia, they do loans, even small business loans down to 100,000 or even smaller. And Export Finance Australia, they actually assisted one of my businesses when we acquired a company in Germany. They assisted the funding for us to buy a company in Germany under one of their small business packages. So the company we bought was only €500,000, but they provided, I think it was about 300,000 Aussie dollars to assist us in that acquisition. And quite flexible, actually very fast, I think 10 days from application to funding. Very, very good to work with. CEFC, Clean Energy Finance Corporation, fairly niche, again, large amounts of money. They will do equity investment and loans. Now, I just want to quickly speak about this because the next slide actually picks up on the TRLs. So you need to understand where you are on the TRL pathway. So TRL 1 is, an idea, a basic principle, something that you've invented. You've got to get to TRL 9. So TRL 9 is a fully fledged business. The type of business is the factories I walk in and out of, and you visit, and some of your business partners, they are TRL 9, fully operational, often global or national. On that pathway, you can see those steps through from invention and research. They could be a university spin out, proof of concept. It's all been done. You've proven the risk, taken the risk off the table. You've done some bench level, that's TRL 4. When you start to get into pilot scale and open customer businesses, you're getting into TRL 5, 6 and beyond. So understanding the maturity of your business on the TRL scale is needed, because you'll often be asked that question. So you can use that slide or easily Google that one. Now what I've done here is I've lined up the TRL levels at the bottom and also looked at the quantum of funding on the y-axis. So at the very early stage, low TRL, the FF and F, that's founders, friends and family. They are people that you've floated the idea at a barbecue. They've said, Dave, we want to back you on this one. We believe in you. You've had good success in the past. And that's where often businesses start. Or crowdfunding, which is internet-based. It's a lower regulated environment, but you can get independent funding through crowdfunding. Surprisingly, many businesses over the years that I've met have started with pure private debt, gone into credit cards, raised personal loans, borrowed against their house, and started their business that way. And that was often in those low TRL levels again. They want to get that the first lot of major customers out, and that's all done internal funding. Bootstrapping is another term that's used in this area. So then you get into the outside equity, angels. Most cities have little angel investor groups, and if you can tap into those angel funds are small amounts of money, but often risk money, and they will also work with you to try and coach you into expansion. Now, I've got a line in there which is grants. Don't discount grants. Grants, they're non-dilutive, so you get the grant money and it doesn't dilute your equity. So you still own 100% of the business and obtain a grant. They can be all sorts of things, from export market development grants to some state grants, some federal grants. So there can even be grants through some of the major corporation venture funds can provide grant money as well. So coming up through grants, a lot of people do it. The RDTI, referred to, the Research and Development Tax Incentive, has been essential for so many businesses that I've met over the years, where they're using that RDTI to give them that cash boost once a year. When they lodge their tax return, if they're a corporation, not a trust, they can use the RDTI to self-fund some of their research and development. Venture capital. So venture capital has got various facilities. So seed capital, it's a little bit beyond yourselves. You've got someone who's going to put some risk money in. That's equity, and that seed capital is fairly common. There's another one called Safe Notes, which is fairly recent, probably the last 10 years. And Safe Notes, I've actually met a couple of people in this IPO program, the IGP program, that have mentioned they've raised money with Safe Notes. Now, Safe Notes stands for Simple Agreements for Future Equity. So Safe Notes are exactly that. They're not a loan because there's no interest. They're not actually equity because they don't take an equity interest. It's non-diluted at that stage. It's an agreement to fund, but it's not even a loan because it's not repayable. So it is a risk money that can be converted to equity at some future date. Fairly common in the US, becoming a little bit more common here. Now, when they say simple and when they say equity, they're neither simple and they're not really equity. So I've seen Safe Notes that have what they call a cap value, that I'm going to give you $1 million and then I want to convert my shares, my $1 million into shares at a later date. but at a value that the company is never worth more than $5 million on value. So my million will always give me, in that case, 20% of the business. So that's one way. It's either a cap on the value or a percentage of the ownership, and there can also be discount structures. So when you go to raise money, if I've got a safe note on your business, I can say, well, I can step in and raise money on that as well, but I get a discount to what you're getting with others. So I get a discount on the share price of 20% or 25% or something. So that's what a safe note is. So it can be a cap, it can be a discount, it can be a cap and a discount, it can be a step-in right where allows that if someone else is raising money with them, that they can step in on those same or most favoured rules. So if the owner of the business is getting a loan from someone else on a better term than what I've given on the safe note, my safe note might say, I can pick that term out of that agreement and put it in my agreement as well. Most favoured condition. So safe notes are coming. You may hear about them. That's what they are. So Series A, B, and C is more traditional. So doing a Series A run, which is raising money to get to TRL 5 or 6. And then often there's a follow-on for commercialization in a Series B, a growth amount, Series C. There can even be Ds and Es in some cases. Uber did 17 funding series prior to the IPO. So it can go a long time, but you've got to have some pretty patient investors to do that. Lines of credit, non-dilutive, which is excellent. It means you go to the bank, you raise some money. That can be trade finance, asset finance of some sort, over equipment. It can be over buildings within the business, or it can be invoice financing. Mezz debt is a more expensive one. It's a more risky for the lender because they're lending in with very limited security, but it can be quite expensive. On today's rates, it could be 12% to 22%. Not uncommon, but that last little bit of growth might need a mezz debt arrangement. Private equity sits in there, which I mentioned before. Generally, TRL 7 and above for private equity. IPO is TRL 9. You've got a fully operational business. You're looking to expand or take some cash off the table. It can be a 10-year journey, but IPO doesn't often happen in Australia. There's very few IPOs occurring at the moment, and they're quite large. So there used to be hundreds a year. They're now down to dozens a year in Australia. So that's the TRL versus the quantum of funding. See some questions coming through already, which is great. So finding the right investor. So find one that's the right fit for your business. There are investors out there who have been in manufacturing, have exited manufacturing, and are now looking to roll that back into other manufacturing businesses. So finding someone who's from manufacturing who supports you in your manufacturing journey could be useful. It might be someone who has been through a particular type of fundraising activity, like an IPO. If you think that's your exit pathway, finding an investor who can take you through on that journey to an IPO is ideal for you to find as well. It could be someone who's got a time horizon similar to yours or experience similar to yours, or is in your industry or adjacencies. So getting the right fit. Also work out where you think that investor should be from. Is it from your market here in Australia or into your target market? And then you've got to do a fair bit of work to try and track down the veracity and validity of those overseas investors as well. What questions would you expect from an investor? Those questions would normally, as an investor, I would ask them, what's their journey, what's their exit? So how long before you have an exit event, or we call it a liquidity event, how long before you get to a liquidity event, and what would that look like? Is it going to be a trade sale? Is it going to be an MBO, a management buyout? Do you have some keen people within your business that within the next 3 or 4 years may want to buy you out? Will they then take over that senior role, and will my money stay in there, or will other money stay in there to take you on that journey to a final exit? What security, what type of investments that you're receiving and what security they want, and how they will convert. So if it's a convertible note, for example, what are the conditions on conversion and what rights do they have in the meantime? So they're questions that you will get pressed on. And I'll deal with a couple of things on the next slide on that as well. Position your business for long-term success. What does success look like for you? And then how do you get it to that stage through the right investor to take you to that market? So this is the process where you'll have investors looking at you, but you've got to turn that around and look at them and try to work out which of those investors is the right one for you on that path. How detailed is their due diligence going to be? How burdensome is their reporting requirements on you later on? If you don't have systems in your business that are able to provide very detailed, instant reporting directly to the investors or to the board, then you will not be ready for investment. So what is that going to look like? And make sure that your internal systems are going to position you to be able to get that investor on board and also help the investor with your exit later on. Traps to avoid. I'll actually touch on that in the next slide because I think going too early sometimes is a big trap. Finding an investor in an early stage when you're not quite there, your valuation is not quite there. So how do you then get through that to that point of actually capitalizing on the right amount of money for your business at that point? This is an area where possibly safe notes work well, because safe notes don't need a valuation of the business, because you may not have revenue, you may not have profit. So in a safe note, you can agree on a price. You can agree on a theoretical value that you're both comfortable with, that you convert at a later date. So once you've agreed on that, that's great, because that's where safe notes would assist and getting rid of that burdensome valuation part of it, if you can both agree on what the valuation is now, or the conversion in year 1, 2, 3, or 4. So I'll just take you through some tips here on what to deal with when you're faced with an equity or debt deal sheet. Develop your NDA now. So have your own NDA. Often a private equity firm will have their own NDA that you want to sign. But if not, have one ready. If the PE firm is providing an NDA, NDA is a non-disclosure agreement. If you have an NDA from a private equity firm, get it vetted. If you're not familiar with it, get it vetted by your lawyer, so that you can understand what they're receiving and their ability to share your information with others. So sometimes a PE has a pool of private investors behind them, and if you give them an NDA that says they can't tell anyone about it, then they actually can't go to their investors. So an NDA provided by a PE firm will have the ability for that PE firm to take your deal out to their investor network. So just be aware that NDA will deal with that. Now, the term sheet, often called an NBIO, a non-binding indicative offer, an NBIO, that's often provided by the buyer or the investor. If not, you may need to develop one up yourself, which actually provides all the terms of the deal: the price, the conversion, the due diligence period, whether there's warranties or whether there's not. So if you're selling a business, you don't want to have warranties. Anyone buying your business will want warranties galore. They want pages of warranties. So if you want to control that, develop up your own term sheet. Prepare a data room. There's a lot of data room providers around there. Ansarada, I've used that. Visible is another one. Wholesale Investor has one through Capital HQ. All of these provide very good data rooms. And the one from Capital HQ, for example, you can set it up. You can set it up with your web links and everything as well, so that as you make changes to your website, it feeds through into the data room. It can link to your social media, your YouTube channels, your LinkedIn pages. So as you're putting posts on those, it will appear in the Capital HQ data room that you're providing to investors. So have a look at them. They're all got different pricing structures, but prepare a data room. And believe me, just a general Microsoft SharePoint is not going to cut it for most operations when you're dealing with these. So you want to be able to know who's opened certain documents, how long they've spent on those documents, have they downloaded them, and that type of thing. So, and also the documents you're sharing, these data rooms will watermark that document. That you, when the document is downloaded, it'll be more watermarked with confidential statements. It'll be dated, all of those types of things. So don't underestimate a data room. They're very valuable. Keep people informed. Keep honest communication to your investors in the due diligence process, but also in the post-investment process. Tell them the good news. Don't surprise them with the bad news. Keep them up to date all the time. Be informed about the terms in the agreement. So what are the investment triggers? Can they step in and run your business? What veto rights would they have on your business? And whether there's a non-dilution clause. So for example, if an investor is investing in your business at a valuation of $10 million, and it's going fine for a couple of years, and then it struggles a little bit, and you need to raise more money. If you raise more money at, say, a valuation of $8 million, then you may find that there's what they call a down round dilution that your first investor has tucked into the agreement that says if you do a down round, which means you're raising money at a lower price than they've invested in, then what happens is that they get additional shares as if they've bought extra shares in this round for free so that they don't dilute. So down round dilutions, if you see that word in the agreement, be aware of it. The non-dilution clauses, which are similar, but it can even be in an up round, but you can have a non-dilution in that as well. One other trap that I've seen people go into is around these dilution ones, is when they've raised money, they might be pre-revenue, pre-profit, but have got an amazing potential in their business, and they think the business is worth 50 million. And they get someone to invest in that business at 50 million. With the dilution clause, what will happen is that that investor becomes the gorilla in the room and won't allow any new investment in. Because if I was going to come in and look at investing in it, and I assess the business is only worth 20 million, I can't invest because the $50 million investor is going to provide such a dilution that it makes my investment worthless. So don't take money on an overinflated valuation when you've got dilution clauses, because they feed into each other. So be aware of those. Be aware of veto powers. Be aware of unanimous powers or majority powers that you can't approve a new business plan each year unless they approve it. So those types of things. You can't sack senior people unless they approve it. So, and the other one is step-in rights. So if you're not running the company right, or if you're not following the business plan, can they step in and run that business? And often a private equity deal will have those step-in rights there as well. So be aware of those ones. I could do another presentation on what a private equity deal, tips and traps on private equity deals. So there's just a few of them that I wanted to cover, and we'll go through others later if you want. I'll pass over to, so thanks for that. I'll pass back to Tyson, and he'll just run you through that, and there'll be some questions coming through. So Tyson's going to curate those as well, if you can do two things at once. See how we go.
I'll give it a go, Paul. Thank you. I know we covered a lot of ground, and there are a few questions to address. I just want to reiterate a point that Paul made early on. This is general advice, and Paul mentioned a couple of times there that you should seek the advice of experts in each area. But we're more than happy to address the questions now. So the first question, Paul, was from Duncan. And whilst we're reading out Duncan's questions and the others, just on the screen are a couple of upcoming AMGC Connect events. So if you did want to or wish to join us or learn more about them, you can email us or ask your advisor, your business advisor through the IGP program to be pushed through to us. So Duncan asked, Paul, can you give an example of some of the major corporation venture funds that provide grants you mentioned?
So Google Ventures in some areas will provide grant funds. It's heavily focused in the US. They often attach rights to those grants as well. Some of the others, I think there's some Rio. I think Rio has one. Some of the pharma businesses do when there's some research funding available for particular things. Again, they might attach rights to those as well. So they're the sort of companies, they tend to be very large and international companies, but they're also trying to satisfy some of their own research needs or expansion needs, and will reach into smaller businesses or universities and capture some of that growth in those early stages.
I think, Paul, we've had a couple of projects over our lifetime at AMGC, and one of them was also Woolworths's W23 Ventures. So there are quite a few kicking around depending on the focus of your business. Second question was from Robin. Is there a difference between safe notes and convertible notes?
Yes, there are. Convertible notes generally have an interest payment on them. So a convertible note it actually does convert to equity, and all of those conversion triggers are in the document. But a convertible note generally has interest payable or interest accumulating. So be aware of that. Whereas safes almost always don't have interest on them. They are just funds in with a right to convert at a future date. Very simple, supposedly, until you start to get down into the nuances of some of those transactions. But they're the difference. One has a debt instrument, and a safe note is not. Under the accounting standards, I'm not sure where you would put a safe note on the balance sheet. And under taxation rules, one thing with both of these, with either convertibles or, I'm going to step a little bit into tax advice, but get your own advice on this. Safe notes or convertible notes, let's say you do convert that note into equity 5 minutes prior to a sale. When that happens, let's say you converted $1 million and the business sells for $6 million, you got a $5 million gain. If that conversion process can't be backdated to the original date through an option agreement, then all you're doing is buying today, selling tomorrow. You don't get the general CGT discount, the general capital gains discount, where you pay tax on half the gain. So be aware that if you do those conversions very close to a liquidity event where you're exiting with money, you can double your capital gains tax simply by not having the right timing on it, or the right clauses within the agreement that convert the note into really an option agreement. So be aware of those, get some advice, because they get very, very complex in capital gains. Even one of the rules I had in practice was we'd never give capital gains tax advice on the phone because there are so many tricks and traps in capital gains tax advice. Please get advice on those sort of things before you do raise these types of debt instruments.
Thank you. The next question is from Peter. How common is it to offer a royalty on revenue, and what options are there if royalties exceed profit?
I haven't seen royalties at all in 40 years of these types of structures in business in Australia. Now, I'm not playing in the pharmaceutical industry, so I'll put that aside, or in the fast-moving consumer goods. I would imagine there are royalties and triggers in there for those. But if you're in a situation where the royalty will cause you to go into a loss situation, then that may trigger other problems with your debt instruments with your banks, for example. If you have a profit covenant or a debt equity covenant with your banks, and your royalties are pushing you into a loss situation, then you've got more problems than just paying the royalty, because that can cause a default event on the instrument. In terms of royalties from overseas, be aware that most countries that operate, if you've got an Australian business and you're operating internationally, if a royalty has been paid from an overseas company to Australia, then there's generally a royalty withholding tax. Australia has a large number, a noodle bowl of double tax treaties with countries all around the world. We have one with America that seems to have been thrown out on the 2nd of April. But those double tax agreements give rules around how these things are taxed. So if you pay interest in a foreign country, often there's a dividend with an interest withholding tax. There can be dividend withholding taxes, and there can also be royalty withholding taxes. So again, taxation advice is crucial. If you structure correctly, profits made overseas in an overseas company that you wholly own, and it's a proper trading company, when you send those dividends back to Australia, they're tax-free in Australia. So they're called named income, non-assessable, non-exempt income. So you might see that as an advantage, but then there's other triggers where you can fall through a trapdoor if the entity is, for example, a hybrid type of entity. It's not actually a company, it could be a partnership. So getting into a bit of detail there, but the question around royalties can be an issue with international tax as well.
Thanks, Paul. Questions are coming in thick and fast. So Alex has asked, you mentioned, Paul, getting distractions off the books. What are some ways of handling this when your IP shows applications in disparate markets, such as medical and mining, which have quite different investors, which would have quite different investors, sorry.
Yeah, I wonder whether in that situation you would have a holding entity and two sub-entities then, one in one market, one in the other, where you can then staff them with people who are focused on those particular ones. I'm not sure the scale of your business, Alex, but if there is an opportunity to split the business to provide a key focus into those two markets, that might be good. If you've got a smart investor who can understand that there can be situations where you do have to walk and chew gum, then that's fine. Distractions that I'm talking about are things like holiday homes and boats and things like that on balance sheets. They're distractions. Or I love engineers. They make the world, but engineers can get very distracted and they can start to move towards a product that, gee, if only we did this, that'd be great. Whereas it then delays getting that product to market. Getting product to market is the key issue to turning profit, to turning revenue, to meeting your agreed strategic plan at the beginning, not saying, oh, well, no, we didn't meet that strategic plan, but what we've done is we've decided to do this in titanium instead of stainless steel, and that's the right thing to do for the market. No, the agreement needs to be discussed with your investors whether you go ahead with the stainless steel or whether you move across into titanium at a later date. So distractions are anything that takes you away from your core strategic plan. That can be all sorts of things. But one of the rules that I have is if someone does own a big boat and they love their time on the boat, I see that as a distraction. That's a red flag. It might not be an issue, but it's a red flag. A friend of mine who is a liquidator, coming from the accounting profession, we make friends with liquidators because they don't have any other friends outside the accounting profession. But a friend of mine in liquidating said, I'd be surprised at the number of businesses that he's walked into to take control of as a liquidator or administrator that has a fish tank in the foyer. I go, what? And he said, we call it the fish tank index. For some reason, a large number of businesses that have the fish tank in the foyer end up going broke. I don't know what the link is, but there's a high percentage. It's one of those things that we look at it, and I've always taken that one in mind. I walk into a place that's got a fish tank, I go, whoa, what's going on here? So you'll find distractions as you go through that will make sense to you as you see them.
Right. I hope I do this question justice, Paul. Corey has asked, Delaware or Europe have been asked of us from a VC pre-investment approval. Can you do both?
Not with the one company. Delaware or what was the other one? European?
Europe.
Europe. So Europe is Europe. Europe is 28 locations. I've got a GmbH in Germany, and it operates and looks after my whole time zone, my European time zone to Northern Africa, and it operates beautifully out of there. You can also do a startup type funding, like a venture funding on the Frankfurt Stock Exchange. So that's a different type of funding as well. The Delaware corporations, a lot of people form Delaware corporations in the US because of the simplicity of dealing with the US 50 united, supposedly, states of America. Delaware corporations are a lower touch. The courts in Delaware are very, very commercially oriented. They're not just legal based, they're also commercial based. So there's a lot of advantages and also local sales taxes as well. There's advantages in Delaware corporations in the US market. Just from personal experience, I won't say there's bitter experience. I had a company in Michigan. I have a company in Michigan. I have a company in Illinois. I've now combined in the last few months both of those operations into the one location in Illinois, and I couldn't open bank accounts in Illinois for my Michigan entity because I didn't have that company in Illinois. So you can have banks, and by the way, my Michigan bank couldn't operate in Illinois. So when you start to choose locations in America, realize that you're not dealing with one country, you're dealing with 50 states. And the rules around banking, there's 4,000 banks, not 4 banks like we've got. And they don't have rules of being able to lend in certain markets. So I've had to do a thing called redomestication of my Michigan company into Illinois to change effectively from the beginning its place of incorporation. Now I'm 10 months into that process. So still not done, but apparently it's close. So be aware of where you set up and the type of entity you set up and the type of bank you use and choose. Even realtors can't operate out of their state. And remember, states there are very small. So real estate, bankers, insurance agents, accountants are very insular and don't have often reach into other states. So take that, when they say, I'm going to set up in America, where in America and why and with what entity and what location, what are you trying to achieve? So it's a bigger, there could be 2 whole seminars on this or webinars on this one, Tyson, but
No, we're getting to the point at the end.
But Corey, I probably haven't answered the question completely there, but happy to take that one offline because there's a fair bit of detail in that one.
No worries. I might get you to just pop the next slide up, Paul. We've got 5 questions and 3 minutes to go officially, so we'll do our best to get to everybody. We might run a minute or 2 over, depending on Paul's availability. If not, we will come back to you. If you did want to pose another question of Paul, please use the connect@amgc.org.au address there in the bottom right-hand side of this page. So, Paul, the next question is from Brody. First of all, he said, thank you for your presentation. So we appreciate the feedback, Brody. What kind of investors would be interested in exploring opportunities using a safe note? Would this only be PE funds or would there be opportunities in the public funds also?
Look, I haven't seen them used in public funds at all, and I've only seen them used very recently in talking to some of the IGP participants who are using them. And those funds, those investments have been made by I suppose you call them family offices, but often they're just a smaller family office investing in a particular company. So a family office may use them. VCs may use them. They were originally invented by Y Combinator, and Y Combinator use them regularly because they're fast and they allow a broad range of structures and are cheaper to get up and going because you're not taking charges and everything over the company. So it can operate theoretically in VC and family office investment. I haven't seen any in PEs. I'd be surprised if a PE would do it because it gives them no equity right whatsoever, and private equity is equity. So I haven't seen it in PE. Now, have I seen it in government funds? No. nothing like that in government funds. I can't imagine a government fund advancing money that is 100% at risk with um, no pathway to equity except on a certain triggering event down the track.
Great.
Thanks, Brady. Good question.
The next one is from George. Paul, George owns 100% of a startup. He needs 10 professionals to bring his clean tech innovation to market. How much equity should be allocated to each of those 10, considering I have 2 other persons and looking to bring other founders?
10 other investors would do my head in.
Sorry, 2 other investors. So 10 staff and 2 other investors.
10 staff and 2 other investors. Okay. So 10 staff are looking to invest as well?
I'll repeat. He says, I need 10 professionals to bring clean tech innovation to market. How much equity should I allocate to each, considering I also have 2 other persons and are looking to bring on other founders?
I see. So those 10 people are within the development team, I would imagine. So um, with those, if you're doing it as a pure equity rather than an employee share scheme, so I'm not sure which way you're thinking. If you're using an ESOP, there's very mature structures you can use where allows those 10 people to come in and out, 10 professionals. I would try to bracket them into a group if possible, so that they're the close participants working in the company under an ESOP or as a founder type. Once you start moving into the outside investors, they may force that on you as well. So say, let's have an ESOP for these internals, raise money from the outside. So the question is, how many investors? I wouldn't want to go more than 20 in total because that changes the nature of the investment model and how you interact with those shareholders. But I try and structure them. If you're raising money from, say, 5 others, and then they might be putting in, say, 50,000 each, and then you're looking for investors to put in $1 million each later on, then you can group those smaller investors into a bare trust that allows them to invest as a bare trust. It counts as one investor, and then it gives you a lot more flexibility to then raise more money down the track. So again, very specific advice. But George, I'd suggest you get some advice on whether you use that bare trust model, whether you use an ESOP model, or whether you just go fully fledged, everyone's around the table with equal type of rules and rights. That would be difficult. That would be a difficult situation to work with.
All right, and we'll run to the finish line, Paul. 3 to go. This is just a clarifying question around something you said from Natalie. You said, be careful of overvaluation because of, and they couldn't catch the last bit of the statement.
Possibly overvaluation because of down round, the down round dilutions. And the other one was, I mentioned also overvaluation, where you end up with a gorilla in the room that effectively blocks any other investment at lower values down the track. So not even the point of a down round dilution, it just becomes, investing in a company, but it's been overvalued from day one. How do I invest in that company when there's already someone invested, maybe only $1 million, but at a $50 million valuation? And they've said, well, we are guaranteed a certain percentage, and that then crowds out everybody else out of the space. So it's really around those things. Overvaluing the business might sound great because you're getting some money at a high value, but it can be a real thorn in your side later on when you're trying to do commercialization rounds.
Great. Kelvin's asked Paul, do you have an example of what a good term sheet might contain? And that might be something we have to go back to Kelvin on.
Yeah, we can go back to Kelvin on it, and I can give you heads of agreement of term sheets that I use or have been thrust at me in the past as well. So yes, I can give some heads of agreements there.
No worries. And the last one in the field is from Tom. And Tom, we may have to come back to you on this. Paul, CEFC as a debt and equity provider, what's their range of value of investments? I know for a fact that CEFC's biggest single check was 490 million, but I don't know what their smallest was.
No, I don't know. I haven't kept involved in them because I haven't been sort of playing in that part of the market. Um, we can come back to you on that one, Tom, what the smaller end of the scale is as well.
Great. So that handles every question that's come our way. If you did have any further questions or wish to follow up on some detail, you're most welcome to contact AMGC Connect directly. And before we all log off, I'd just like to thank Paul for his time, insight, and knowledge. And everybody is most welcome to, put the word out to your advisor and be referred through if you wish to talk to us on any more details or tap into any of our network. Thank you, Paul, and thank you everyone for your time, and enjoy the rest of your week.
And Tyson, I think we're sending a questionnaire out. Please fill out that survey because there are other events that we're going to pop up later, and we'd like to get some guidance on the type of topics that interest you. It could be on NBIOs, for example. It could be on traps of capital raising, anything. So send us a note, fill out the survey when it comes out from Amelia. That'd be great. Thank you.
Brilliant. Thank you all. Thanks, Paul.
No problem. Thanks.